You're listening to this article from Convertz.app. How inflation affects exchange rates. The relationship explained. The basic relationship. Inflation and exchange rates are deeply connected. At its simplest, countries with higher inflation tend to see their currencies weaken over time relative to countries with lower inflation. This makes intuitive sense. If prices in one country are rising faster than in another, each unit of that country's currency buys less. Investors and traders recognize this, and the exchange rate adjusts to reflect the difference in purchasing power. But the real-world relationship is far more nuanced than this simple rule suggests. How inflation erodes currency value. Purchasing power. Inflation means the general price level is rising. If inflation in the UK is 5% and inflation in the US is 2%, then over the course of a year, prices in the UK are rising roughly 3 percentage points faster than in the US. This means the British pound is losing purchasing power faster than the US dollar. Over time, this differential puts downward pressure on the British pound's or US dollar's exchange rate. The purchasing power parity, PPP, theory. Economists formalize this relationship through purchasing power parity. PPP states that exchange rates should adjust to equalize the price of identical goods across countries. If a basket of goods costs $100 in the US and the equivalent of 80 British pounds in the UK, the implied PPP exchange rate is 1.25 US dollars or British pounds. If the actual market rate is 1.27, PPP suggests the pound is slightly overvalued and should depreciate. In practice, PPP is a useful long-term anchor but a poor short-term predictor. Exchange rates can deviate from PPP for years due to capital flows, interest rate differentials, and market sentiment. The central bank response. Here is where the relationship gets interesting. Central banks do not passively watch inflation erode their currency. They respond, and their response creates a counter effect that can temporarily strengthen the currency even during periods of high inflation. The interest rate channel. When inflation rises, central banks typically raise interest rates to cool the economy. Higher interest rates. Number 1. Make deposits and bonds in that currency more attractive to foreign investors. Number 2. Attract capital inflows as investors seek higher returns. Number 3. Increase demand for the currency, pushing its value up. This is why a country experiencing high inflation can sometimes see its currency strengthen, at least temporarily. The market is pricing in the central bank's response, not just the inflation itself. Real interest rates. What matters most is the real interest rate, the nominal interest rate minus inflation. If a country has 5% interest rates but 6% inflation, the real interest rate is minus 1%. Investors lose purchasing power even while earning interest. If another country has 3% interest rates and 2% inflation, its real interest rate is plus 1%. Despite lower nominal rates, investors earn more in real terms. This is a key driver of exchange rate movements. You can observe these dynamics in real time by tracking currency pairs on tools like our currency converter. Major rate decisions often trigger immediate and visible moves in exchange rates. Real-world examples. The Turkish lira, 2021 to 2025. Turkey provides one of the most dramatic modern examples. In 2021 to 2023, Turkey experienced inflation exceeding 80% at its peak. President Erdogan's unconventional insistence on cutting interest rates during high inflation caused the lira to collapse from around 8 per US dollars in 2021 to over 35 per US dollars by 2025. When Turkey reversed course and began aggressively raising rates in late 2023, the lira's decline slowed, but the damage from years of high inflation was already embedded in the exchange rate. Japan's yen, 2022 to 2025. Japan experienced the opposite problem. While other countries fought high inflation with rate hikes, Japan maintained ultra-low interest rates. Even as Japanese inflation rose to 3 to 4%, the Bank of Japan kept rates near zero for much of this period. The result was a widening interest rate differential between Japan and countries like the US, which had raised rates to 5% plus. The yen weakened from about 115 per US dollars in early 2022 to over 150 per US dollars. The US dollar, 2022 to 2024. When US inflation surged to 9% in mid-2022, many expected the dollar to weaken. Instead, it strengthened significantly because the Federal Reserve responded with the most aggressive rate hike cycle in decades, pushing rates from 0% to over 5%. The high interest rates attracted global capital, overwhelming the negative effect of inflation. The inflation exchange rate feedback loop. The relationship between inflation and exchange rates is not one-directional. A weaker currency causes additional inflation by making imports more expensive. This creates a potential feedback loop. Number 1. High inflation weakens the currency. Number 2. The weaker currency makes imports more expensive. Number 3. Expensive imports push domestic prices higher, more inflation. Number 4. Higher inflation weakens the currency further. This inflationary spiral is what central banks desperately try to prevent. It is most dangerous in countries that rely heavily on imports for essential goods like food and energy. What investors and travelers should watch. For investors, track real interest rate differentials between countries. This is a stronger predictor than inflation alone. Watch central bank forward guidance. Markets move based on what central banks are expected to do, not just what they have done. Monitor inflation expectations, like break-even rates from Treasury inflation-protected securities, rather than just current inflation. For travelers and consumers, high inflation destinations can offer better value for tourists from low-inflation countries, as the exchange rate often adjusts faster than local prices. Plan purchases around exchange rate trends. Use tools like Convertz.app to track whether a currency has been strengthening or weakening before converting large amounts. Inflation differentials explain why some travel destinations become more or less affordable over time. The bigger picture. In the modern global economy, no single factor determines exchange rates in isolation. Inflation is one of the most important long-term drivers, but it interacts with interest rates, capital flows, trade balances, political stability, and market sentiment. Understanding the inflation-exchange rate relationship gives you a framework for making sense of currency movements. When you see a currency weakening, ask, is the country experiencing high inflation? How is the central bank responding? What are real interest rates compared to other countries? These questions will give you a much better understanding of where exchange rates are heading and why. Disclaimer. This article is for educational and informational purposes only and does not constitute financial, investment, or economic advisory services. The examples cited are historical and are not predictions of future performance. Always consult qualified professionals for decisions about investments or financial planning. That's the end of this article. Visit Convertz.app for more guides and free conversion tools.